Good evening and welcome to another riveting edition of Bond Squad's Bond Squad After Hours broadcast for April 22nd, 2015. As always, Bond Squad and Wealth Strategies and Management are separate entities from Private Advisor Group. Private Advisor Group is a registered investment advisor, and that's through whom we get to manage people's portfolios. So that's the secret, by the way. You know, PAG gives us a ton of support when it comes to that. Works with the firms at which our clients' accounts are domiciled at. So we joke around a bit, but PAG has always been there for us, and we do appreciate it. Well, this week we're going to discuss durable goods and, by extension, GDP, the difference between economic errors and economic era, and we'll also discuss a little bit of of liquidity risk, because, in this model portfolio or modern portfolio theory world, liquidity risk has gotten to be a bad name, because it got to be a bad term, because it seems that everybody needs to trade in and out of everything. Nobody's an investor anymore. We buy things to hold for a quarter or a year, then we got to get out of them. Everybody's a trade in. That's you're in well into a bull market, because everybody's looking for trade ideas, and nothing can ever go down. And the central banks will make everything okay, and nobody invests anymore. Who wants 3% for 10 years in a triple B corporate? We need to get 10% now. Okay, 75-year-old Mrs. Smith, good luck, and good luck. Put it in. Go put it with PIMCO Total Return or some other fund where they're going to bet futures and credit default swaps and God knows what. Good strategy if you trust the manager, and if you're looking for total return, not so great if you're looking for income and capital preservation. When you're looking for return of your principal, you might return on your principal. You might get return of your principal. But let's start with the economic data. On Friday, we're going to have one of the two big economic reports before next week's Fed meeting, and that's durable goods. Durable goods, quite simply, are items meant to last longer than 3 years. This includes vehicles, aircraft, appliances, anything that's not really disposable. And because aircraft can be very volatile, they also report a core number, X transportation. Because Boeing gets a big order one month, it skews the number. Boeing doesn't get an order the next month from a major airline, it skews the number the other way. So I know that using core data is being criticized, but there really is a purpose for it. So we look at durable goods, and the folks on the street think durable goods orders will be up 0.6%, 0.6%, and core X transportation up 0.3%. Not really what you want to see in a spring rebound, but considering that even core durable goods last month fell 6.6%, it will take what we can get. Capital goods orders, a proxy for business investment and spending, automation, productivity, it's expected to rise 0.3% after falling 1.1%. Last month, rather. I said the quarter before, it should be last month. And look, we welcome any return to positive territory, but let's not kid ourselves. Those aren't spectacular numbers, but it'll probably prove that the first quarter was a weak number. For weather, for cyclical, we believe, and we wrote about this the other day, and Steve Leisman comes out with today on CNBC, correctly so. He notes, and we've noted this too, we put a chart in our Making Sense report, that the first quarter has been weak for years, for a decade or more. And we went back just during this recovery, and we hate calling it a recovery because the economy's recovered. This is it, guys. This is the economy by this time. After you go 6 years, it is what it is, as they like to say. But they noticed that first quarter GDP in every year, going back, I think he went to the early 90s, was weak. It was the weakest quarter of the year, be it an expansion, a contraction, or recession, be it a sideways moving economy. First quarter was always weaker. And it might be something in the seasonality adjustment, as Steve said on CNBC today, where not all the components are seasonally adjusted the same way. And that was supposed to calm us all, say, oh, Don't worry about first quarters anymore because, you know, the seasonality formula doesn't work and we get the rebound. All right, true. That means that when you have the big rebounds in Q2 and Q3, they're not real either because the seasonal adjustment is not factoring in the seasonality, right? So you're getting a big jump back from Q1, and if the seasonality formulas were working right, it should be smooth across the board. You should go, so Q1 should look like Q2, like Q3, like Q4 for the most part. But when you have negative 2.2 last year in Q1, and then positive 4, I think we were 4.2, and then positive 5 in Q3, and then positive 2.2 last Q4. You know, there's something in there. You can't say, oh, only the soft numbers are true, are not true, but the big numbers are. So, like we wrote the other day, and coincidentally, we wrote this. I believe we wrote this on Monday. The days do run together when you're pretty much a one-man show, a good one-man show, but a one-man show nonetheless. Was that, you know, what you have to do is look at the annualized number. So last year, the U.S. economy grew at 2.4. Since the recession, it's been 2.2. You know, if we go back further, it's been closer to 3. 2.2 is probably what we really are. So you can't say, well, we would have been 4.5 if it wasn't for that bad January or that bad winter. Well, that's part of the number. And if it happens every year that's the soft number, and that you have a rebound, and it seems like the softer the Q1 number, the bigger the rebound the next quarter or two, right? So if that's happening year after year for a decade or more, then you have to say that's real, okay? So you can't say and during the 1960s, if the Mets had the Cardinals lineup, we would have won a couple of World Series, right? But you know, we can go on and on with the what ifs. But the thing is, when you look at all 4 quarters, that's probably giving you a good indication of what the economy is capable of at the present time. And it still looks to be a mid 2%, maybe for like a high 2% economy with accommodative Fed policy. Now, we agree that Fed policy is very accommodative. We don't think it's as accommodative as people, including the Fed, think it really is. In other words, you know, the Fed's probably going to go sometime this year from 0 to a quarter point on the Fed funds rate. We don't think it goes much above that for the rest of the year. Once it moves, maybe an eighth, and it brings you to 3/8 of a point. And Bond Squad's forecast is still that we're not going to be higher than 1% at the end of 16. Okay, there's no impetus for it. You know, people are seeing like monsters under the bed when they look at inflation. CPI went from 1.7 to 1.8. Okay, that's good. You know, and now the retail's moving into tips. Interestingly, institutions are not. We asked our contacts on the street, our counterparties, people that we do business with on the institutional side, and zero, zippo, none, nada, yet have seen institutional buying of tips. It's been retail driven, mostly by the investment firms seeing a trade, seeing a technical pattern. They're saying, all right, go in and buy tips. We got a little inflation. There's probably going to be some rush into the asset class. So you had a trade there. All right, folks, if you are a retail investor or you are a retail financial advisor, do you really want to be trading tips? I mean, yeah, if you have some mad money and you think you can pull off a quick buck, maybe. There's probably better places to do that, though, in the markets, don't you think? Tips are really quite simple. They adjust for inflation, right? They should be used to hedge a bond portfolio. So what you do, you look at your duration of your portfolio and you buy a tip or tips to match that duration. You know, that's pretty much what retail should be doing. You know, you don't need to buy a tips fund or a tips ETF or a portfolio tips. What are you trying to diversify? You're not diversifying credit risk. You're buying the same risk. You're just buying different spots on the curve. All right. Why not just buy a 5-year and a 10-year tip, get your duration in and around, 7 years and be done with it. You know, if you want to hedge out inflation. It really is that simple. It's like Rube Goldberg. This business is like Rube Goldberg mousetraps, man. You got to roll balls through down ramps and through baskets and hit levers just to catch the damn mouse. It's really not that complicated, you know. And it seems like every trading strategy we're seeing out there, or we call it trading strategy, it's modern portfolio theory. You know, we're losing models that no longer work, and we've kind of proved that again the other day with comments from both Ben Bernanke and John Taylor, the creator of the Taylor rule, that you can't just use algebraic formulas and just forget about it. They have to be constantly tweaked, which modern portfolio theory says don't tweak them. That puts human error, potential human error into it. Okay. Fine. Go use the microwave and just press and don't cook too. Whatever. Go get a self-driving car and text your life away. All right. The models are backward looking, and we think the error here that's being committed is that investors, advisors, and especially these portfolio strategists do not realize that we are in a different era of economics. We read something the other day, and this would spark this whole idea of eras, economic eras. We kept reading articles the past week, and more so before as well, but more so this week, saying this has been the norm in the post-war era. This has been the norm in the post-war era. This hasn't happened in the post-war era, whatever it might be. As if there was some line of demarcation in the economic sand that said the world was different before 1945, August or September 45, when the treaty with Japan was signed. And there's one world before and one world after, and it's been constant since September of 1945. It hasn't. We'll make the case that there was a post-society economic era, post-Great Society economic era, that coincided with the baby boom economic era. Then there was the Paul Volcker / Ronald Reagan economic era. Then there was the post-Cold War economic era. Remember that big peace dividend we had in the 90s, where we were supposedly freed up from worrying about the Cold War and defense spending and whatnot, and the economy took off. Well, that was an era, and that helped fuel the tech bubble, by the way. And then there was a post-tech bubble era and a post-9/11 era, unfortunately. Right? Then we had that jobless recovery, right? And which makes us laugh that people think that something's really different now. We had the jobless recovery in between 9/11 and the housing bubble. Right? That was an era. Post-housing bubble financial crisis is another era. Each time the economy changed, so each time the models need to change, and each time the portfolio strategists go, damn, model's not working. Yeah, must be something wrong in the economy. Maybe the bond market has it wrong. Yeah, bond market has jack wrong. Bond market is probably the most accurate thing out there right now. Not saying that it's perfect, and believe me, it's not where rates are right now and such, but it's probably more accurate than almost anything else that we can tangibly see. So we're tied to these old models, and we say, look at this job growth we get. We're getting 250,000 a month we're averaging over the last year, but the wage growth really isn't picking up, and the labor force participation keeps dropping. That can't happen. It reminds me of my time at Citi when I walked by two quants and they were talking about these mortgage delinquencies, and so the model says this can't happen. Well, it's happening, guys. Like we wrote the other day in World War II, the Battle of the Bulge. Intelligence were telling the troops who were being overrun by Tiger tanks, it's impossible. The Germans don't have that many tanks. Tell the guy with an 88 pointing at his nose. The Germans had the tanks. And that's what we believe that these models fail to grasp. So what's different now? Again, we have a situation where it's cheaper to hire workers right now than it is to modernize equipment. Now we had Jim Paulson from Wells Capital Management on TV today saying, look, it is different, and we agree with Jim. It's different. He says you could have inflation without a higher labor force participation. You can have wage pressures, without increasing the labor force and whatnot. Well, here's the problem. Let's say you have a smaller labor force, and you're running out of workers, which is arguable whether you will or not. But let's say he's right, and you start to run out of workers. You have a small labor force, and you're hiring a higher percentage of them, and you get to NAIRU, the naturally occurring inflation rate of unemployment, right? The unemployment rate, which neither adds nor subtracts to wage pressures and inflation. And you get there, and now these companies are faced with, gee, I can give these people raises. I can put this piece of equipment in. All of a sudden, the equipment gets bought instead of giving people raises, and maybe people get fired. The other thing is we have a flexible economy, right? And the regional Fed data, for the most part, has been indicating though companies have been hiring, the work week has either shrunk or expanded at a much slower pace than hiring has occurred. So what's happening is we have a situation where there's no wage growth. They don't have to add wages, and if they give you an hourly wage, they cut your hours. All right, you're going to make $12 an hour instead of 10. By the way, you're working 20 hours instead of 25. Nobody was working 40, right? So that's what they do, and they keep their expenses down. And what's your alternative? Well, you can go down the street and get another part-time job. It's a flexible economy. We have just-in-time delivery. This is why sometimes the inventory numbers don't work with the rest of the data anymore. Companies don't have to inventory things months ahead, except maybe around the holidays, because they can just-in-time everything. You know, it really is that simple. So we do think the economy is improving, and we think you'll see inflation pick up on the headline, not just the core. Why? Remember how annualized inflation works. It works on prices now versus prices this time last year. So eventually, you're not going to have that disinflationary pressure from oil prices. And the oil prices are up a bit. They're up about $10 a barrel or so in the last month. But even if you had no pressure on oil prices from $46, right, you would still not have that disinflationary pressure. Come later this year or the end of the year, because you'd be back to where the year-over-year didn't change. So now your core basket would actually push the headline number up. So what should happen over the next year is not so much core inflation continues to rise. It's at 1.8 on CPI, which translates to about core PCE right around 145, 1.5, nowhere near the Fed's the target or comfort rate of core inflation. But the biggest move is probably going to be that the headline inflation reconverges. Remember, they separated because of falling oil prices. They're going to reconverge probably somewhere in the mid to high 1%. This means that there's not much of an impetus for long-term rates to rise dramatically. Yes, they could pop over 2. We're at 197 on the 10 as we speak. It was up 7 basis points today, or 198 actually right now, up 7 from 191. I apologize. But maybe it goes over 2, and maybe when the Fed announces that tightening is coming, that's a knee-jerk reaction, especially from the fund people. They'll sell their fund shares like 13, and we'll see the 10-year go to 2.5 or 260 or maybe even 270. And then all the money's going to rush in again. There's tons of money looking for bonds around the world. And when Germany's at 7 basis points and you can get 270 in the U.S. or even 250, or even 2.25, the money's coming. It's coming. And the aging population needs it. And the aging population makes the insurance company and the pension funds need it. And not just the pension funds here, which are shrinking as far as number of pension plans, but overseas, which is almost all pension. 401ks really don't exist outside this country. Especially they don't exist in Europe or Asia. Okay? So all that money's looking for a place for yield. They need to preserve that capital. They can't go, buy stocks. They go up every 10 years, except for the 1970s. And between 2000 and the financial crisis, they can't take the chance. They can't take the chance doing it, because even though it looks good now, what do you do if you're wrong? So they need to preserve that capital. So they're going to buy fixed income. It's that simple. And as all rates go up, wham, they're going to come back in. And we've already got color from the street that the hedge funds are building cash positions to take advantage of a bond route. We have retail portfolio strategists telling investors, go buy tips because there should be momentum as we get some inflation back. As if 1.7 to 1.8, God, you'd think that we had to call Paul Volcker up again, judging by some of these guys on the TV. We went from 1.7 to 1.8 on CPI, and like, inflation's back. Yeah, please call up Paul Volcker. Get him back running the Fed. We need to bring the 10-year to 15%. We got to stop it from hitting 1.9 for crying out loud. It's ridiculous. But we have not seen any indication of institutions buying tips. We asked for color. One of our contacts on the street said that he hasn't seen any institutional buying of tips. In fact, he's seen some institutional selling of tips as they think it's getting a little overdone. We would tend to agree with that. And it seems like in this world, everybody's looking for an angle to pick up yield. They're looking at linked securities, linked to baskets of God knows what, that'll pay if the basket, the underlying basket stays within a certain range, or doesn't break out a certain range, or does break out of a certain range. And we'll buy weird things on the structure, things that float off of God knows what. And one of the better ways, in our opinion, especially for buy and hold investors, to pick up yield is to take on a little of liquidity risk. Liquidity risk is usually found in bond issues or $25 par bond issues that look like preferreds that have small deal sizes. So getting out of them might be less than easy, right? But if you have a portfolio of bonds and you're going to hold it to maturity, and you have other assets that provide liquidity for you besides this, you could pick up some yield by taking on some liquidity risk. And it seems like that in this stupid fund-driven world, this where everybody owns the same bond issues in every fund, because they have to buy the most liquid things, making them in a sense the least liquid things. If there was a sell mentality in that asset class, none of these funds can buy these smaller deals. So for the last few years, we've been picking off these $25 par senior notes, issued by the various banks and brokerage houses and some industrials. And sometimes for like 7 to 10 years, we were getting 6%, yields on stuff that maybe were non-rated. Some of them were triple B. Some were non-rated because they were the only or one of two bond issuances out there by the respective companies. But the credit profile was excellent. It was probably equivalent to a high triple B or low single A in some cases. But because they're not going to go pay Moody's and S&P to rate one or two bond issues, not worth the expense, it's cheaper for them to pay a higher yield on a non-rated bond. So that's where we were looking for value, and they've worked out very well. Now people have caught on, and these bond issuers aren't issuing them anymore. Because now they can go into the loan or the standard corporate bond market institutionally and get better deals. Lower yields, lower coupons to pay, and but for a long time we were cherry picking that, and you could pick up some nice yield if you're willing to sacrifice some liquidity. So if you have spots in your portfolio in which you don't need to sell, that you're going to hold to maturity, and you don't care what the price does in the interim, you take on a little liquidity risk. You could do, and investors do that, and they might not even realize it when they buy medium-term notes. These weekly medium-term notes, like the old GMAX Smart Notes or the various Internotes with the death puts on them. Those are tiny deals. Some of those deals are only 10 to 50 million in size. 10 million bonds used to be a relatively small trade in the corporate bond institutional market. A typical deal now is 1 to 3, maybe even 4 billion in size for a single issue. So single issuance. So it's funny that investors, when they bought these medium-term notes, weren't concerned about liquidity. And the problem is that they didn't. We think that they didn't realize that they were taking such illiquidity, and maybe they didn't care because they had the death put on them. So it's basically who had to die first, the customer or the company, or the bond if it matured. But that was one way of doing it, but of picking up yield through illiquidity. The problem was that so many retail investors went into that the yield advantage shrunk. The demand from it let these companies issue these small deals, which they used like as patchwork to fill in the gaps in their financing. At yield levels similar to what they were getting on the large liquid global deals. But there are ways to do it, and we think at Bond Squad that if you're investing in with the crowd, and by that we mean crowded trades where you're in a portfolio, be it a fund or an SMA manager who's running the same portfolio for 1,000 clients, so everybody has the same bonds, and they have the same bonds as the other SMA guy because, well, you have to have only the largest liquid deals, and they have the same bonds as the mutual funds. Well, what happens when there's a fire and the room starts burning? Well, everybody has to run to the door, and not everybody gets out, right? At least gets out unsinged. And that could happen too with some of these bonds, even good quality bonds. Now, if you had the bonds you can hold to maturity, you don't care. In fact, you might want to buy some more when everybody trying to run through the door knocks the price down. But if you don't own the actual bonds and those bids are actually hit, this way the SMA manager is better than the fund, at least, because at least the SMA manager, hopefully you can hold on to him unless he decides to liquidate him, then you need a new manager. But if you can hold a bond, let it go down. You can hold it to maturity. There was a great discussion on Bloomberg Television last week, and they had a guest on, trying to talk about dark pools and whatnot, and saying that we need the liquidity because some of these investors are going to get hammered, when there's no liquidity and these bond prices drop, and they'll take losses. And one of the hosts of the Bloomberg show said, no, they won't. They got to hold to maturity. If they hold to maturity, they're getting par. They get their money back. And the guy says, yeah, well, most of investors don't actually own bonds. That's probably true. And it's sad because they've dumbed down this business so much for expediency. We travel the country. We visit different firms and different offices, and we hear sometimes, when we're talking about our SMA program, they're like, yeah, I'd like to do bonds, but it's difficult. It's time consuming. It's not my thing. So I know the dangers of not using actual bonds, but it's too hard. And when we were out there saying, we were asked, so what's your bond strategy? What does your intermediate corporate portfolio look like? We said, we built each one custom. I gave them an outlook, what we look for in such a portfolio. But I would say, but we built each one custom. And they said, whoa, how could you do that? You don't get good pricing. That's another lie that the fund people say. We get great pricing. Yeah, really? Okay. You ever hear of an electronic communications network, an ECN? They're more prevalent than you think. And you can sometimes cherry pick odd lots at cheaper prices than round lots now because people are trying to get out of the little pieces. Plus, what I'm looking at now, besides the camera, is my Bloomberg terminal. I get lists of bids and offers and markets and color and whatnot from around the street. And it's really not that difficult for me to do smaller trades. Maybe I have to put two of them together and make 100. But it's sometimes easier to trade 100 than 1,000,000 of certain issues at this point, because the dealer desks can't take inventory the way they did before. So, and the problem is the investors and the advisors don't realize how things have changed. Another change of an era. We no longer have dealer desks positioning inventory who would take you out of a bond, especially if you were a client of that firm. If you were a client of a firm and you needed to sell a bond, chances are, because it was in-house, your desk would give you a bid and you'd be able to get out of it, even if it was in a liquid bond. And we saw that. We did that. I did that in the old days for people. I might pass on a bond if it came in from the street. I don't want to own 25 bonds of some schmo issue out there. But if it was one of my FAs with one of the firm's clients, I'm going to put a bid on it. Because it's my firm, and I pull them together. I might even, if I could pull enough of them together, might even reoffering them within the firm. And it was great when I was at the old Wertheim Schroeder, small firm, just a close group of advisors. I would tell them, here's the market, here's the two-sided market on it. Give me an order, I'll work in the middle. It was really that easy. In the old days, we actually used to work for our advisors that way. Now, I don't know. That's not the same world. So it's been a change of an era. And if you don't realize that, then you're making an error. We're looking for the economy to continue to improve. We think job growth slows into the low 200s, which is still not too bad at this stage of an economic cycle. Maybe wage growth picks up a little bit, but if it starts picking up too much, you're going to see more efficiencies come in. The dollar might have bottomed for now. Oil might have bottomed for now. We wrote back in late January that we had a feeling that we were getting near a bottom, and we were. The Fed is very conscious of the dollar right now. They think that the stronger dollar has taken about 0.6% off of what growth would have been otherwise. So, we moved our GDP forecast for Q1 to 1%. As of the other day, as of I think Monday, it was the Bloomberg consensus was still 135. Now the consensus is now 1% along with us. So, that's for Q1. What would Q2 bring? I don't know, 3. Remember you have the downturn, and you got the snapback, and then you have the reset in the fourth quarter. So when you had the down 2.2 last first quarter, you got the 4 plus, then you got the 5, then you got the 2.2. Here you might get the 1, and then you might get the 3, then you might get the 3.5 or 4 before Christmas, and then you might slow down to 1.5 to 2, or from 2 to 2.5 at the end of the year, and you end up averaging 2.6, 2.7. Still an improvement, but that's probably what it is, and that's if everything goes right. We still have Europe. Yeah, it's coming. It's doing better. Germany now thinks it might grow at 1.5 instead of 1. That's Germany, and it's still 1.5. And then you have German bond yield negative out through 8 years. People keep looking at Europe, at the EMU, the Eurozone, as the U.S. 5 years ago. We look at it as Japan 15 years ago, 20 years ago. We look at Japan as they're just trying to hold off the inevitable. Yeah, they made some minor reforms, but it's pretty much one of a shrinking economy because it's a shrinking population. And the equity markets will do all well and good because there's no alternative. And heck, the Bank of Japan keeps buying equities, including U.S. equities, by the way. Then you have China, which tries to deflate their equity bubble, and that's an equity bubble, guys. They're using borrowed funds instead of buying real estate. They're buying stocks with it internally over there. So they said we're going to raise the margin requirements and ease the short selling restrictions. And then the markets tanked last Friday. Then over the weekend they say, you know what? That's too hasty. Don't think of it. We're not going to be that harsh. And by the way, we're cutting the reserve requirements on the banks by 100 basis points so they can lend more. Party's back on. So how do you avoid a hangover if you've been drinking? You stay drunk. And that's what China's doing. And at some point, they're going to have to there's going to be a day of reckoning. The problem is China has so much extra cash in the trillions that they can keep this party going for a long time. But as anybody who's partied before knows, the longer you stay drunk, the worse the hangover. And even Hank Paulson, former Treasury Secretary, who's a big China supporter, and he even speaks Mandarin fluently, is warning of this. He's like, China can't go on like this. They're trying to change from an export-driven economy to an internally driven economy, but there are a lot of growing pains and speed bumps along the way, and it's not going to be easy. So, heading into next week's Fed meeting, we believe the Fed's comments are going to be very neutral, maybe even slightly dovish. We were thinking maybe it's slightly hawkish a while back, but Atlanta Fed President Lockhart, who is probably the most neutral as far as being a hawk or a dove, pro-tightening, anti-tightening. He's probably the most neutral. He's even suggesting now that maybe the Fed has to wait a bit. New York Fed President Dudley, probably the most influential regional Fed president, hinted at that the Fed, may be less aggressive than originally thought. So we think the Fed statement is relatively neutral, maybe slightly dovish. They're probably going to say that they want to tighten this year. They're not going to take June off the table, but we think they kind of push it out towards September a bit. When that happens, we think we see maybe rates could come back down again. We think they're going to revise the economic forecast lower. Remember, the Fed's been overshooting on their forecast tremendously in the last 6 years. Rather than the real numbers coming up to the Fed's level, we think the Fed's expectations are going to come down towards reality, towards our 2.5% economy, towards our 2.1 to 2.2% wage growth, to our labor force that may be permanently under 64 or 63%, so down to the 62s, or let's not say permanently, say generationally, and with inflation low. We don't, like you said before, we said this months ago, we don't believe in the deflation story. We believe in the lowflation story. So you can have rates very low. You can have the Fed funds rate at 1% next year, and you still might not get inflation above 2%. That's where, and you still might not get the 10-year much above 2. And that's where, and that's probably the way it is. How long can the equity markets hold out? I don't know. The equity markets are building in, continue building forget about economic recovery, economic performance, corporate performance. But we've noticed in almost every earnings report is that the companies are missing on the revenues. And eventually the revenues are going to matter, because you can't keep doing financial engineering unless you can keep lowering your debt expense. And that's going to be a problem. So with that, we'll let you go for the week. We'll be writing tomorrow, and we'll have our In the Trenches report over the weekend. April and May are two big times a year for our resubscriptions. So reminders have gone out. We've gotten some resubscriptions already. Sometimes they end up in spam folders, so please be on the lookout for that. If you know that your subscription's coming due and you have not seen a reminder, let us know. We'll send it out. Send a link to resubscribe out to you again, or we'll help you in some other way. And with that, have a great night. I'm trying to watch the Rangers off to the side. They're losing 1-0 to Pittsburgh, and they're playing as well as me, which is not saying much. So have a great night, and take care.